Most of America is counting down the days until the Federal Reserve Bank starts cutting interest rates again so you can go out and buy a home with a 3% mortgage. Wait, did you say the home is listed for $400,000? Offer $525. The question is, number one, when will interest rates go down? And number two, what will happen when interest rates go down? Let me start by answering the first part of that question. When will interest rates go down? Because that's the easier part to answer. The Federal Reserve Bank is the entity that's in charge of cutting or raising interest rates. During the last Federal Reserve Bank meeting on January 31st, 2024, the Federal Reserve Bank came out and said not only are they not interested in cutting interest rates right now, but they also said that they do not think that they're going to be ready to cut interest rates in March 2024. Now, just to make sure that we're on the same page, the interest rate that I'm talking about here, the Federal Reserve Bank's interest rate, that's not the interest rate that you pay when you go to get a mortgage. When you go to get a mortgage, that's kind of like the retail interest rate. That's the interest rate you pay as a consumer, but when banks go out and borrow money, that's the wholesale interest rate, because banks also have to pay other banks when they borrow money from each other. That's the wholesale rate. This is the interest rate set by the Federal Reserve Bank, and right now the interest rate set by the Federal Reserve Bank is 5.25% to 5.5%. The reason why this matters is because if the Federal Reserve Bank cuts their interest rates or raises their interest rates, it changes the cost on the bank to borrow money, and if their costs go down, they have the ability to potentially lower your costs. It doesn't guarantee that they're going to lower your rates, but they have the ability then to lower your costs. And if the Federal Reserve Bank raises interest rates, well, the cost on the bank goes up, which is why mortgage rates and credit card rates and auto loan rates have gone up so much in 2022 and 2023 and now into 2024. So now the Federal Reserve Bank doesn't meet every single day to decide what they want to do in interest rates. Instead, they have designated meetings. They had a meeting January 30th and 31st, which I already talked about, where they said that they're not raising interest rates and they're not planning on raising interest rates in March. That's what they said in January. Now, of course, we're not in March at the time of recording this video. The Federal Reserve Bank can always change their mind, but as of today, the Fed says that they don't plan on raising rates in March. That means that the soonest that the Federal Reserve Bank could potentially raise rates is in their April 30th and May 1st meeting. Now, are they going to do that? I don't know. If they don't do it then the next meeting is June 11th to 12th. After that is July 30th to 31st. After that is September 17th to 18th. After that is November 6th to 7th. After that is December 17th to 18th. For the Federal Reserve Bank to make an interest rate decision outside of these dates, they would have to call an emergency meeting in order to do that. But right now, we don't see any emergency meetings happening, which is why the decisions that they have to make to cut or raise interest rates are likely going to be done on these dates right here. Now, before I go further, I want to remind you that on February 6th, which is right around the corner right now, I'm hosting my first ever wealth building workshop. It's completely free, it's live, and I'm going to be going over a few things. Number one, which is how our economy is changing, and then number two is how you can use your money despite all the changes in the economy. This workshop on February 6th is going to happen 2 times, once in the morning, once in the evening. On February 6th, yes, I'm going to be hosting them. Yes, it is live. Yes, it is free. And I'm going to be going over now what you can do with your money right now to start building wealth and potentially start generating cash flow. This workshop is completely free, and if you'd like to join me, all you have to do is register because, well, there's a limited number of people that can join me live. I would love to have you there. It's my first time doing it. It's going to be a lot of fun. And if you'd like to join, I got the link for you down in the description below. So now that we've laid the foundation as to when the Federal Reserve Bank will cut interest rates, the answer is I don't know, but these are the options. And if you want my personal opinion, which is just my personal opinion, the Federal Reserve Bank needs to keep interest rates higher for longer because the inflation problem is a much bigger issue than the interest rate issue, because if we start cutting interest rates too early, it makes the inflation problem worse, which ties into exactly what I want to talk about now, which is what happens if the Federal Reserve Bank starts cutting interest rates. Now, my goal with this video is not to talk about my opinions, is rather to talk about facts. So let's talk about facts. The Federal Reserve Bank was cutting interest rates in 2019. In fact, the Federal Reserve Bank cut interest rates 3 times in 2019 to do what? Well, it was to help stimulate spending and to help stimulate the economy. Let me read you an excerpt from the New York Times, that way you can understand why the Federal Reserve Bank was cutting interest rates then. The Federal Reserve Bank announcement to cut interest rates came on a day when the new government figures showed that the American economy had inched lower in the last several months, and this week's decision to lower lower interest rates was intended to, quote, provide some insurance against ongoing economic risks, and this is from Jerome Powell, quote, overall, we see that the economy has been resilient to the winds that have been blowing this year. The reason why I'm showing you this is because I want to show you the Federal Reserve Bank's justification for cutting interest rates. We just got economic data saying that the economy was not growing as fast as was expected, and there are headwinds to the economy, and this is where the Federal Reserve Bank is cutting interest rates to help stimulate spending, to help stimulate economic growth, to fight off an economic slowdown. Then after the year 2019 came, of course, 2020. And in 2020, the United States economy was hit hard by the pandemic and our economy was shut down. And of course, the Federal Reserve Bank cut interest rates all the way down to zero, to the lowest levels we have ever seen before. Now, Ken, the question is, why was the Federal Reserve Bank cutting interest rates? Why were they so adamant on bringing interest rates down to zero? This might seem very obvious, but stick with me, you'll see why this is important. But the reason why the Federal Reserve Bank did this is because they wanted to stimulate the economy. Our economy was shut down in 2020. So now, in order to stimulate a dead economy, what do they want to do? They wanted to stimulate spending because our economic system runs on spending. If you don't spend money, our economy doesn't work. The more money you spend, the more money somebody else makes. So in order to spur spending, they cut interest rates all the way down to zero. That way people felt more comfortable getting a mortgage, buying a car, and putting money on their credit card, and well, it worked. If we just take a look at the housing market was booming during the pandemic because everybody wanted to go out and take advantage of the 2.5% mortgages and the 3% mortgages and the 3.5% mortgages, and people were willing to way overbid for homes because, well, who cares about the purchase price? You can get a very cheap mortgage. That was the sentiment then, and this created a huge boom in the housing market. And what did they do? Home sellers were making money, title companies were making money, realtors were making money, mortgage companies were making money, contractors were making money. So it created a boom in the economy because people were spending money. Lower interest rates spurred spending to encourage the economy to grow. So now we've taken a look at the last two times that the Federal Reserve Bank went through these rate cutting cycles. We saw it happen in 2019, and then we saw it happen in 2020. Now the question is, if the Federal Reserve Bank starts cutting interest rates now, what would that do? And let's just start by taking a look at what's going on in our economy today. And the most recent economic data that we got says that our economy here in the United States is growing faster than expected. Now let's go back a little bit and think about what stimulates our economy. Well, if you remember what I said just a minute ago, our economic system runs on spending. The more money you spend, the more money somebody else makes, and the more our economic system moves. Well, when I look at spending today in our economy, people, Americans, are spending money like crazy. People are spending money they don't have, which is why we have a record amount of credit card debt. People are turning to buy now, pay later. People are spending money, and they're spending money they don't have. Now, I'm not saying this is a good thing. I just want you to understand what's going on in our economic system. So now we are in an economic time today where our economy is still supposedly very strong, where people are still spending money. And if the Federal Reserve Bank were to start cutting interest rates today, what would that do? Well, what we know from history, again, we just talked about 2020 and we talked about 2019. The reason why the Federal Reserve Bank cuts interest rates is to stimulate the economy. How do they stimulate the economy? By making borrowing money cheaper in order to incentivize people and businesses to go out and spend more money. Well, we are in a time today where the economy is still supposedly very strong. And we're in a time today where people are still supposedly spending a lot of money. In fact, people are spending way too much money, but that's besides the point of this video. But people are spending money and the economy is still very strong. So if the Federal Reserve Bank were to start cutting interest rates, well, what would happen? If we think about the past, that would mean that people will be incentivized to spend more money. People will be more incentivized to go out and buy a home. Now, of course, we're already in a very weird housing market where you have not that many sellers, and you still have a decent amount of buyers. So if we were to enter a time where mortgage rates, let's just say, were to fall to 4% tomorrow, you bet that a lot of buyers are gonna wake up out of their slumber and say, oh, finally time for me to buy a home again. And now you go and look for homes that are available for sale for $600,000. You go to make an offer for $605,000 thinking that you're making a good offer, and then you hear that this seller got 4 offers for almost $700,000. Are you interested in raising your price? Now, the reason why that's significant is because, well, the reason why the Federal Reserve Bank has been raising interest rates in the first place is because of inflation. We all know this now. Say it with me, inflation. And so if inflation has to do with higher prices, which come from all the money printing that the government and the Federal Reserve Bank did, let's think about this now. When you have high inflation, what does that mean? That means the prices of things have gone up quickly. Well, if interest rates get cut today, and people continue having the ability to spend today, and you start to see more people buying, and we could talk about homes, whether it's cars, it could be really anything, but let's say people are buying, what's going to happen to the prices of things? And you can understand the housing market, because as a very easy example of this is, if mortgage rates were to go down, you bet that there's going to be more buyers out there, and that's going to create more demand, and that's going to create more bidding wars, and that's going to create higher prices for homes, which means higher inflation numbers. Higher inflation numbers mean bad news for the Federal Reserve Bank, because the reason why they've been raising interest rates in the first place was to fight off inflation. Now, this is why the Federal Reserve Bank has been hesitant to cut interest rates too soon, but these are the things that you want to think about. Not to mention the fact that the Federal Reserve Bank has also mentioned that they want to keep a close eye on the labor market, meaning they want to keep a close eye on unemployment, meaning they want to keep a close eye on how many people have jobs, because they have said time and time again that they want to soften the labor market, aka they want to see a cooling of the economy, and they want to see more people lose their jobs. And the reason why is because if the economy is not so hot, then they have more fuel to stimulate the economy. But today we're in a time where the economy is still hot. Now, you got to understand, the Federal Reserve Bank and the government have both come out and said that they're expecting some sort of cooling of the economy in 2024, with unemployment potentially rising and our GDP, our economy, potentially slowing. Now, if we start to see more economic pain, you can ignore what's going on with inflation, but if we start to see more economic pain, you bet that can give the Federal Reserve Bank more ammunition to then start cutting interest rates, because they don't want to cut interest rates during a booming economy, because that can overheat the economy. But if they start to see that cooling nature of the economy, with people start losing their jobs and the economy starting to slow, that gives them more ammunition then to start potentially cutting interest rates. And this is where I don't want you to be one of those people trying to time the economy. I don't want you to be one of those investors just panic selling, panic buying. There's a lot of emotion out there, okay? Think with me on here, or work with me on this, okay? Let's take a second. I'm just gonna be very honest, Jaspreet Singh with you. I want you to be a long-term investor. What we have seen for the last 100 years is that the people that have made the most money are the people that do common sense investing. It's not the people that are panic buying. It's not the people that are greed buying. It's not the people that are panic selling. And it's not the people that are greed selling. It's the people that understand that the American economy has been resilient for the last 100 years. There's going to be crap that happens in our economy. It's happened in the past, and it's going to continue to happen in the future. We have seen booms and busts happen in our economy pretty much every decade for the last century. And guess what? They're going to continue happening. And in fact, they're probably going to be even more severe and more volatile in the future. However, we have the most resilient and strongest economy in the world. And that's going to require you to have the most discipline, which unfortunately most of us are never taught, but you're going to need the most discipline than ever, because those booms and busts can create opportunities for you to purchase some investments at a discounted price. But for most people, 98% of America, the way that you make money is not by trying to time the market. It's not by trying to find the perfect stock. It's not by trying to find the perfect investment. It's just by putting your money into the markets, into the United States, into the stock market. And you do it every week, every 2 weeks, every month, whether the market's up or whether the market's down. Listen to what Warren Buffett has to say. There's the reason why he keeps talking about how throwing your money into low-cost index funds every week or every month is the best way for the average person to become rich. It's not by trying to understand every little detail happening in the economy. It's about you understanding your investment strategy. Now listen, I'm a money nerd. I love keeping up with what's happening in the economy. That's interesting to me. If it's interesting with you, keep up with it. That's fine. But don't let the day-to-day news dictate your long-term investing decisions. I want you to be a financially educated investor. Understand that your financial education is here on your left hand. Your financial news is your right hand. Yes, your thumbs can connect, but you got to understand that there's different fingers here, and you want to make sure that the financial news is not completely dictating your financial education and your investing decisions. Can it influence it? Sure. But you got to understand how most people are going to become wealthy, and don't get overwhelmed by emotions and the headlines and the YouTube titles and all that other stuff. I want you to be a calm and sophisticated investor, because that's where the money's built. It's built through the slow and steady compounding. It's not built through all the emotion and craziness. That's where money moves, and you want to be the person that's getting the money. Employment is maximized. Like, we have some of the lowest unemployment numbers that we have seen in a very long time. But at the same time, inflation is still an issue. Yes, inflation has fallen, but it's still high. And this is where now the Federal Reserve Bank has some leeway on the maximum employment part to get this inflation under control.